So, you did it. You just went freelance, or maybe you finally started that side hustle. That's awesome. But you really need to see this because there is a massive tax surprise just waiting around the corner for almost everyone who leaves a regular job. And today, we're going to make sure you see it coming from a mile away.
Let's just think about this for a second. You land a great project, a client pays you $5,000. That whole $5,000 hits your bank account. And it feels amazing, right? But how much of that money is really yours to spend? The answer might genuinely shock you, and it all boils down to the difference between two little forms, the W-2 and the 1099. See, for most of your working life, your employer just handled your taxes. It happened quietly in the background. But as a freelancer, that safety net is gone. All of a sudden, you are 100% responsible for paying all of your own taxes.
All right, let's break this down because this is so important. As a W-2 employee, your company withholds money from every paycheck. They also pay half, 50%, of your Social Security and Medicare taxes for you. It's pretty much automatic. Now, on the 1099 side, you get the entire check. No withholding, and that feels great at first. But the catch is, you're now responsible for everything. You're not just the employee anymore, you're also the employer. And that means you have to pay both halves of those payroll taxes.
And that right there leads us to the single biggest financial shock for new freelancers. It has a name, and it's called self-employment tax. And honestly, this is the one concept that truly separates your old W-2 life from your new 1099 reality.
Memorize this number, 15.3%. This is the number every single freelancer has to know. And here's the real kicker. This is a flat rate tax you'll pay on top of your regular federal and state income taxes. It's made up of the 12.4% for Social Security and the 2.9% for Medicare that you now have to cover completely by yourself.
So you might be asking, why is that number so high? Well, it's because you're not just paying your share of payroll taxes anymore, you're paying the employer's share too. Remember that 7.65% your old boss used to cover on your behalf? Yep, that's your responsibility now, in addition to your own 7.65%. You pay the whole thing.
Okay, let's put some real dollars to this to see how this plays out. Take a look here. We've got two people and they both earn a gross income of $70,000 a year. The W-2 employee pays about $5,300 in Social Security and Medicare taxes. But the 1099 contractor, earning the exact same amount, pays nearly $10,000. That's a massive, massive difference, and it comes straight out of your pocket.
And this chart right here, man, it visualizes that hit perfectly. It is not a small gap. For the same income, you, as the freelancer, are on the hook for an extra $4,500 right off the top. That is the 1099 tax shock. This is the money you have to be ready for.
Okay, I know what you're thinking. How in the world do you possibly handle this? Well, here's what you can't do. You can't just ignore it and wait until next April to write one giant, terrifying check. The IRS requires you to pay taxes as you earn your income, and this is where something called quarterly estimated tax payments come in.
Basically, the government wants its money throughout the year, not all at once. So these 4 dates you see here, burn them into your brain. Put them in your calendar. They are your new paydays for the IRS. For each quarter, you have to estimate what you owe and send it in by these deadlines. If you don't, you can get hit with some pretty stiff penalties.
All right, so how do you make sure the money is actually there when those deadlines pop up? It is so simple, but you have to be disciplined. You're going to use the 30% rule. Every single time a client pays you, I don't care if it's $50 or $5,000, you immediately transfer 25 to 30% of it into a separate savings account. Do not touch it. That is not your money to spend. That is the IRS's money you're holding on to.
But you know, it's not all bad news. In fact, here comes the best part of being your own boss at tax time. You now have an incredibly powerful financial tool to legally lower your tax bill: business deductions. And put simply, every legitimate dollar you spend to run your business is a dollar you don't have to pay tax on.
And here are some of the most common ones. We're talking about a portion of your rent for your home office, the mileage you drive for client meetings. At 67 cents a mile, that adds up fast. We're talking about that new laptop or software you needed, your health insurance premiums, and even contributions to a retirement account like a SEP IRA. If you track them properly,
These are all legitimate business expenses that shrink your taxable income.
So what actually counts? Well, the IRS has a pretty simple test. Is the expense ordinary and necessary for your line of work? Basically, is it a common and helpful expense in your industry? If the answer is yes, it probably counts. The absolute key here, and I can't stress this enough, is to start tracking every single one of these expenses, right down to the last penny. Get an app, use a spreadsheet, whatever it takes, just track it.
Okay, we have covered a lot. We've talked about the shock of the self-employment tax, and we've talked about the two big solutions, paying quarterly and using deductions. So let's wrap all this up with a simple 3-step action plan that you can put into motion literally today.
Look, these are the 3 non-negotiable habits for your freelance financial survival. Number 1, open a separate tax savings account today and start feeding it with 30% of every payment that comes in. Number 2, get a system in place, an app, a spreadsheet, I don't care, and meticulously track every single business expense. Don't leave money on the table. And number 3, put those 4 quarterly tax deadlines in your calendar with alarms and pay them on time. Get these 3 things right, and trust me, you are way ahead of the game.
And that leads me to the final and honestly the most important step of all. While this explainer gives you the framework, your situation is unique. So the single best investment you can make in your new business is to hire a qualified tax professional. I promise you, a good one will save you way more in taxes and headaches than they cost. Please, whatever you do, don't try to go it alone.